All right, guys, bang, bang, lunch money time. While Wall Street's trying to get rich, the rest of us just trying to get our lunch money right. I'm here with Polina, who looks like an angel today, or an artist. I'm not sure yet, haven't decided.
Angel.
Maybe, but don't forget that lunch money is now sponsored by BlockFi. Go get a BlockFi account, 8.6% APY in an interest-bearing account, or you can buy and sell crypto on the crypto exchange, or you can deposit crypto and take out a US dollar loan against that crypto collateral. Go check them out, blockfi.com/pomp. Again, blockfi.com/pomp. What's up?
Hey.
What are we doing?
I don't normally wear makeup on the show, but I have a thing after this, so I gotta okay. All right. The people like me as I am.
Just let's go.
All right. First-time claims for unemployment insurance continued their decline last week, hitting another pandemic-era low in a sign that the labor market is gradually improving. But what it doesn't account for is the people who were kind of dropped out of the labor market completely, right?
Narrative violation. They're lying. They're lying. They're lying.
Why?
Here's why they're lying. It's because 700,000 people filing for first-time unemployment claims would be one of the highest weeks of unemployment claims in history before this year. Right. I think the highest ever was around 800,000. Okay. And no, 800,000 was the highest before 2020. And now we have 700,000. This is one of the worst weeks for first-time unemployment in the history of the world outside of this year. It's just that relative to earlier this year when we had 6+ million people file for first-time claims, it doesn't look as bad. So everyone's positioning as like, it's getting better, it's getting better, it's getting better. No, it's not. But on the bright 700,000 people just filed for first-time unemployment claims.
True, but on the bright side, at least it's declining instead of going the opposite direction.
It's because we ran out of people. We literally ran out of people. There's so many people who filed for unemployment that we ran out of people to file for more unemployment. This is not the ongoing claims, right? So this is the trick that all of these data points show. Ongoing claims would say, oh, there's 6 million people, but now some people got their jobs back, so now there's 5.5, then there's 5, then there's 4, then there's 3 million, 2 million, 1 million. And you'd be like, oh, people are going back to work because it's going down. That's not what this data point is. This is first-time unemployment claims. It means that they've never filed for unemployment before, and they're just now doing it. Saying it's going down just means that literally we ran out of people. There are 55 million Americans. More than 1/3 of the US workforce has filed for unemployment. We've run out of people to file for unemployment. It's not that it's getting better. It's just literally everyone else has already filed for unemployment that lost their jobs. Go ahead.
Some of the hottest private consumer tech companies are rushing to file their IPO prospectuses. I love reading those. So they can go public before the end of the year. Airbnb, DoorDash, Roblox, and Wish are all expected to make their filings public by early next week. So here's what's been so interesting, because if you watch past lunch monies when the pandemic first started, all these companies were pumping the brakes on, oh my God, we're not going to go public this year because of who knows what COVID is going to bring. And now somehow it's a good year to go public.
Well, when the stock market was going down, you didn't want to step in front of a steamroller, right? But now that the stock market's going up, you're going to get on the rocket ship. Like, it's just basically what you're looking for is earlier this year, it was an investor market, right? In March, when everything was falling and there was a bunch of uncertainty, investors hate uncertainty. Companies don't want to go public in an uncertain time. And so everyone's like, whoa, stop, let's not do this because we're going to get crushed in the market. Let's wait. Well, now that all of a sudden you've got this massive recovery in stock prices and it's gotten frothy again, you're seeing people, whether it's through SPACs, whether it's direct listings, whether it's the traditional IPO, they all want to get into the public market so that they can actually raise capital or benefit from that stock price appreciation. Make sense?
Yep.
Airbnb is going to crush it. I'm an investor. Come on. Come on.
I did not know that. Bitcoin passed 16,000, which it hasn't done that in 3 years. I remember 3 years was 2017, right?
2017, it crossed over. It went from 10,000 to 20,000 in 18 days.
Clearly.
It only sat at 20,000 for less than 72 hours. So when you look at any sort of metric around 200-day moving average or any of that stuff, Bitcoin's at an all-time high. The only price point that it is not at an all-time high is in US dollars in the spot market, and it only lasted above 16,000 for like less than 20 days. So it's a pretty big deal. And it feels much, much stronger right now. And it would not surprise me that we keep...
Does it feel stronger because there's more people and more institutions and more people like Stanley Druckenmiller, not Drunkenmiller, making public expressions about it? Or why is it stronger this time?
I think there's three things, right? So one is there's lots more infrastructure in place. So it's easier for people to get access to custody, all that kind of stuff. Two is time and education. So people have spent more time and more learning. They understand the asset more. 63% of all Bitcoin haven't moved in the last 12 months, meaning that the higher educated you are about it, the more likely you are to have strong hands and not want to sell it, which therefore leads to kind of more support underneath the price. And then the third thing is the way that the price is appreciating right now is a much healthier way. It's not like it's going from 10,000 to 20,000 in 18 days. That's obviously some sort of, again, frothy market. Here, what we're getting is a much more kind of slow grind up. And that slow grind up is because there's more and more assets flowing in or capital flowing into the asset. And so that's likely to be less about pure speculation and much more about long-term investors.
You know what it reminds me of? Like when somebody wins the lottery and suddenly gets a lot of money versus someone who builds their way up to that kind of money. One is healthier than the other. Okay.
Absolutely.
Ready?
Yep.
Bridgewater's Ray Dalio sees governments banning Bitcoin should it become material. He told Yahoo Finance that he said he expects more digitized versions of government issued currencies in the future than Bitcoin and other cryptocurrencies for three reasons. One, he said, I today can't take my Bitcoin yet and buy things easily with it. Two, Bitcoin and other cryptos are too volatile, he says, to be considered effective stores of wealth. And three, if Bitcoin or other cryptos become material, he predicts governments will outlaw it. They'll use whatever teeth they have to enforce that.
Bitcoin's outperformed Ray Dalio.
Okay, but what about the government
Which, by the way,
aspect?
means I've outperformed Ray Dalio.
What about the government aspect?
The whole idea that a lot of these guys look at is, yes, from a currency perspective, they are correct that the fiat currencies are going to get digitized, of course. Well, the part of the analysis that they miss is that when everything is digitized and it sits in a digital wallet and you are able to switch in and out of currencies incredibly easy, the friction for switching will be reduced. And therefore, right now, if I want to take my dollars and go get, let's say, the euro, I literally have to go to my bank, or I have to go to like the scam artist currency exchangers in the airport, which, by the way, are complete scams. They rip you off. But in those situations, it's high friction to switch between currencies. Here, what happens is now with the click of a button, I can go from Bitcoin to digital dollar to digital yen to digital euro, back to Bitcoin, into some other currency, whatever. And so when you have that switching cost, the friction reduced, now all of a sudden people are going to allow capital to flow to the soundest money. So what they'll do is it doesn't matter what currency they get paid in. They'll then move to the strongest, soundest money, which is Bitcoin. They'll store their wealth there. And then if somebody says, hey, you know what? I don't accept Bitcoin. They say, cool, what do you accept? And at the point of payment, they can then switch back, again, with the click of a button, from Bitcoin to digital dollar and then pay. And so what ends up happening is you're going to see Bitcoin just become this vacuum of capital. It is just going to suck value to it from all these other currencies, because it is the soundest money. The problem with gold in the kind of the analog application of digital or sound money principles is that the switching cost is so high. If I want to go from dollars to gold and then from gold back to dollars, I can't do it at the point of payment. But when everything is digitized, the switching cost is so low that it's going to happen so quickly. And so yes, actually the digitization of these other currencies is not negative for Bitcoin. It's a positive. It's going to drastically increase the adoption of digital wallets. It's going to drastically increase the ability for people to use these digital currencies. It's going to familiarize people with it. And ultimately what's going to happen is that Ray Dalio is going to look like a not so smart guy because of this. Ray Dalio is a smart guy. He's a very, very smart guy. Great book, wrote Principles. You should go read all of his stuff. He really understands the macro economy. He understands the economic engine, like all this stuff. He's missing the boat here on this one, and it's because he actually has identified the right drivers of what's going to happen. He's missing the conclusion, and I think part of the issue is he's looking at it from an investment standpoint, not from a technology standpoint.
Yes, but I think that somebody like Ray Dalio, his job is to stay on top of like regulation and governments and like how is this going to affect the business long term, depending on what the government does. So
No, Ray Dalio's job is to make money for his investors, and he hasn't done a good job of doing that.
All right, okay.
It's just a fact.
Ray Dalio, you're welcome on the podcast.
Sure.
A research team.
He lost 18%.
Oh my God.
In his all-weather fund. And by the way, he's one of the best investors of all time. I'm just pointing out the fact that like facts are facts. Go ahead.
Let me tell my stuff. A research team at Deutsche Bank proposed that people pay a 5% tax for the privilege of working from home if they continue to do so after the pandemic, as this could subsidize income lost by lower earners due to the coronavirus crisis. In a report published, they say that basically working from home meant that many people were saving on everyday costs such as travel, lunch, clothes, and cleaning, as well as possibly spending less on socializing. However, the report also said it meant remote workers were contributing less to the infrastructure of the company while still receiving its benefits. What?
You corporate thieves. You're
So
thieves.
confusing.
Why would you pay people less money?
Yeah, for working from home. It doesn't mean you're spending less on lunch, let me tell you that, or clothes, let me tell you that.
No, what is the point?
Of what?
Do you pay people based on their consumption, or do you pay people based on their production?
Right.
Of course you pay them on their production.
That's a weird thing.
Corporate thievery. That's what that is. Come on.
Well,
and here's the worst part.
it's Deutsche Bank. They got money.
But it's just the fact that like they would even think about this. They would say this out loud. Like this is one of those ideas that you say,
You don't publish a report on it.
When you think about it, or you say it behind closed doors, somebody somewhere is like, "Hey, we probably shouldn't say that out loud." And these idiots went and wrote a whole report on it.
Okay. Wait, is this right?
Uh-oh.
Yeah, I think it's right. 1 second. Yeah, it's right. Ford Motor expects its new all-electric transit van to help it hold on to its lead in commercial vans as new and long-time competitors enter the emerging market. The vehicle is designed for commercial and work buyers, and it's all-electric.
It looks kind of cool. It's like a little Sprinter van. Like,
yeah.
it's way better than, you ever seen those pictures of the vans where they're like, "Hey, kids, I have candy"?
The Ford e-Transit commercial van will start at under $45,000 when it arrives in dealer showrooms in late 2021. Who do you think the target here is? Who is buying these vans?
I'm thinking that maybe we should buy one and drive around the country. With like a bed in the back, and you make a little breakfast area, a little
Where am I
kitchen.
gonna shower?
I just go in the water. Like in the lake.
Okay. Yeah.
Or go in a
Sure.
gym. You can go in a gym. We can just get like a Crunch membership and drive around the country.
Or we could get,
Crunches.
have you seen, the Alex Honnold thing where he like has a thing on his van and he just does pull-ups on it?
Finger pull-ups.
Finger pull-ups on that bar. Yeah. We can get one of those. But then I'll need to take a shower.
What finger pull-ups are you going to do?
Oh, I have a lot. Upper body strength.
Okay. What is next?
Okay.
We're not getting a van. The electric vans look cool. Probably going to be used for delivery and other things outside of it.
Delivery is what the right answer was. Okay. I have a question. I think this one's for you, but the next one. Okay. Dylan, this is Ask Lunch Money Time. If you have a question, #AskLM in the comments below. We will answer. Dylan Wills. Hey, Pomp crowd. Love the content being created. Young millennial looking to get further along financially. So much information nowadays on invest in index fund, gold, silver, other commodities, Bitcoin, other cryptos, real estate. I understand it depends on my intent and my personal responsibility to choose. I'm pretty liquid with about $50,000 to $60,000 looking to get into investments. Best to start getting into investments. Wait, any thoughts? Thanks for the info.
Dylan, there's 4 rules. Spend less than you make. Have multiple streams of income, get out of inflationary assets like the dollar and get into real assets or investments. And 4 is be patient and disciplined. And for you, the 4th one is the most important here because it sounds like you've got cash to invest. If you got cash to invest, you're likely spending less than you make. Hopefully you've got multiple sources of income. And the whole key is don't go and just put all of your money into something all at once.
Yeah.
Right? Being disciplined and dollar cost averaging into investments means that you don't have to be the smartest person in the room. Are there people who can pick market tops and bottoms? And is this a good time? Is this not a good time? Of course. But you're much better off just saying, okay, here's the asset allocation I want, right? And asset allocation is usually that's usually the most important decision you make, right? So how much of your money goes into the stock market is usually more important than which individual stock you actually pick. which a lot of people don't understand that, but that's definitely true. And so what you want to do is you just want to make it super easy, right? I always tell people, like, just think of it, if I have $100, okay, I want $20 to go to real estate. I want $40 to go to stocks. I want $20 to go to crypto, and I want $20 to sit in cash. Let's just say that that's what you were going to do. Every time that you save $100, you want it to almost be automatic where it just goes into those investments. Almost think of your investments as your savings account, right? You just keep putting money into those investments over long periods of time. So what that means, though, is also you don't want to pick things that are kind of fad-like, right? You don't want to say, oh, Zoom stock's flying right now. Let me go put all my money in Zoom, and then I'm going to like time the market and get out. Sure, there's some people who think that they're good at doing that. By the way, most of them aren't. Instead, the best way to build wealth is to have a very long-term viewpoint and just to constantly put money into the investments over a long period of time, dollar cost average into them, and just allow compounding to work for you.
And because you're a millennial, you have time still. So your risk appetite, your risk appetite should be larger than people in their 50s, 60s, 70s, etc.
Yeah, and time is a really important point because
risk tolerance.
She's right in that. Well, you don't even have to have a higher risk tolerance. You should have a higher risk tolerance, but also it's just understanding if I let money compound for 30 years for somebody who only can do it for 10, I have an advantage. And so it just comes down to people want to try to be too smart, but you don't need to be smart. You basically it's kind of like what Warren Buffett says. You just don't need to be an idiot. Right? And so it's like really, really simple. The timeless personal finance principles are timeless for a reason. Next.
Okay, next. Jonathan Eshetu says, who wins in a rap battle, Paulina or Anthony? My money's on Pimp. You want to go? You want to give me a beat? Come on, go. Do a rap battle.
Paulina doesn't even know how to rhyme words together.
Your name is Pomp. You just want
like I just said. She literally can't.
But ain't nobody mess with me because I am the original PIMP.
Oh, that was pretty good. All right, next question.
Well, I did it.
I gave my suggestion. I said go listen to Big Pimpin'. Here, what about that question?
No, we got that. Diogo.
Y'all want another song? I got another song. Go listen to Lil Wayne, Fireman.
Okay. Diogo's
hot.
Oh my God. Diogo Rocha, okay, says, I have been listening and reading a lot about finances, and I want to start a newsletter to spread my still infant knowledge of the markets, crypto, and self-improvement. Since I will be doing it in my mother tongue, shout out Portugal, I think I have a chance. Maybe this is not the best question, but how do I make my newsletter profitable? Thanks for everything you have taught me.
And I agree with Pomp. Cancel Christmas music.
I wasn't going to bring that up, Diogo. I wasn't going to bring that up.
All right, I like you already. Cancel Christmas music. No. Only cancel Christmas music before Thanksgiving.
I put my little tree up over there.
So, it's a plant. It's not a tree.
It's a tree.
The best way to think about this is there's two different ways to make money generally with newsletters. One is you can get people to pay you for it, so subscription model. Or two is you can do ads. The thing that I always tell people is don't worry about how you're going to make money at first. Just get started. Like just start writing the email and start sending it and starting to build the audience. And what you'll quickly realize is like if you have a huge audience and you think that, okay, if I make this subscription based, let's say on Substack, about 5 to 10% of people will convert to pay you, right? So just use the assumption of 5%. Well, if you only have 100 people, there's only 5 people paying you, right? It's really not going to be that profitable. So actually what you may need to do is you may need to go and get ads in order to make it profitable. And so it's hard to kind of say like what you should do. My best advice is just get started, actually start building the audience, and then you can even ask them. Like you can run a survey and say, hey, would you rather this be a subscription with no ads, or would you rather see ads that are timely and helpful?
And also, I think before you even start thinking about making the newsletter profitable, you should grow your audience. And it sounds like if you're doing it in Portuguese, you could look up some of the bigger influencers or content creators who have Portuguese newsletters or publications, etc., and try to get in front of their audiences as well. But I think that's a great idea.
Absolutely. All right, anything else?
That's it.
Lil Wayne, Fireman. See you guys tomorrow.
Did you like my rap?
Bang, bang. Hope you guys enjoyed this episode of Lunch Money as much as we did.
And don't forget, Lunch Money is now sponsored by BlockFi, so go check them out. There's a link in the description that you can click on. I'm an investor, a user, and a huge fan. What?
You're a bigger fan of BlockFi than you are of me?
BlockFi is my second favorite thing in the world behind Polina. They've got 3 products. They can give you a US dollar loan. You can earn up to 8.6% interest on an interest-bearing account, or you can buy and sell cryptocurrencies on their crypto exchange. I personally use the interest-bearing account. There's not very many places where you'll find up to 8.6% interest on a deposit in an interest-bearing account. Go do your own research. There's risk associated, but 8.6% is pretty compelling. So click on the link in the description. Say thanks to the folks at BlockFi. Subscribe to our channel. Like the video. Annoy Polina in the comments. And we'll see you guys tomorrow.
And be kind to your friends.